Great. Welcome to the Note Investor Podcast. I'm your host, Dan Deppin, and today joined by Brett Swarts from Capital Gains Tax Solutions. So Brett, how you doing?
Dan, better than I deserve. Great to be here. Thanks for having me. It was great to have you on my show a few days ago, and it's cool to hang out with you again.
Yeah, no, I appreciate you coming on. So you're here to help with some topics that my audience often asks about, but is kind of outside of my personal wheelhouse. So maybe you can talk a little bit about, what it is you do and get into like what a deferred sales trust is.
Yeah, absolutely. So most high net worth individuals that are selling highly appreciated assets, something that's like $1 million or greater, right, has a large gain. They struggle with capital gains tax, flexible solutions is what it comes down to. And so we use a deferred sales trust to give them diversification, liquidity, and optimal timing mainly, so they can multiply freedom and unlock, ways to create and preserve more wealth. And so that's a big statement, but basically, people sell real estate, they sell crypto, they sell businesses, primary homes. And when they do, they're looking at 25 to 50% of the gain being wiped out by capital gains tax. And so we'll defer up to 100% of the capital gains taxes. But then, if they're investing into notes and doing what you guys are doing, they can invest into notes tax deferred. And so for the longest time, if you were a note investor, the only way that you could do that is you could sell the asset, pay the tax, and then show up. Well, we like to say sell the asset, defer the tax, and then show up to your note investing or whatever you want to invest in, right? All tax deferred. So think of it kind of like an IRA, a 401k, a self-directed one where you can, I'm sure you guys know about that, how you
Mm-hmm.
can direct that. Think of it like that, but we're creating these mini IRAs with these mini 401ks for multi-million dollar exits. And so I'll give you an example to kind of bring this home. So we did a $13 million exit in California. And there was four partners, and they had built a car wash on this 2-acre lot. It was this like old taco stand, By the way, San Diego has some of the best burritos in the world, right? I went to college down there and played basketball there. And so they approached the taco guy and they go, "Hey, you got this taco stand, you're doing pretty good business, but what if we put you inside of a car wash and like 3 or 4 extra business?" He said, "Sweet." And so they made a deal with the guy, and they purchased the land, put the tenant inside of their car wash. Well, all in, they were in for about 4 million. Well, they sold for 13.5 million. So that gain, they're going to hit with a 40% capital gains tax on the gain. And
Mm-hmm.
so they're looking around and they're looking at their 1031 binoculars. This is about 2 years ago. Like, this doesn't make any sense. Why would we 1031 into the highest market perhaps in history? Number
Mm-hmm.
two, where a market we think is going to shift here pretty quickly, right? Number three, they had some debt. They needed to pay off. They wanted to pay off some debt. And so they made a great decision to use the deferred sales trust. They got out of debt. They got tax deferred. And guess where they went with most of their money? Into lending, a lending fund, right? Where they're
Okay.
making 10%, but all tax deferred. So I'll pause there, and maybe you have some questions we can kind of dig in some more.
No, I was just thinking that's a heck of a car wash business. When I was in high school and college, I worked at a car wash part-time in Florida in the early 90s. So yeah, that can be kind of a tough business. So tough to build a $13 million one.
Oh yeah, so they built it actually for 4 million, but you're right, but they got so busy that the value of the real estate and everything was 13 million for the business and the real estate. But you're right, to
Mm-hmm.
build it from scratch to it's wild how much value you can build with car washes if you do it right.
Yeah. Now, is this actually like a retirement account? Like, do you have to wait to withdraw money from it, or how does that work?
Nope. So it's actually not a retirement account. And this is what's so cool about it. So whether you're an entrepreneur, whether you want to be retired or somewhere in between, you have the ability to take back payments from the trust and pay tax slowly over time. And so this is how it works, right? And so instead of the $13.5 million at closing going all to the sellers in this scenario, we set up 3 trusts. There happened to be 4 sellers, but one of the sellers just wanted to pay his tax. The other 3 had a trust set up, and they assigned their interest to the trust in exchange for what? A promissory note, right?
Mm-hmm.
They did an installment sale. Again, your listeners and you guys are very familiar with this.
Yeah.
They did an installment note, but they didn't do the installment note with the buyer. They asked the buyer to come with all the cash and get it, come and get a loan somewhere else. And the trust jumped in between the buyer and the seller. And the trust
Okay.
bought it for 13 million and sold it for 13 million. And so what happens there, Dan, right? It's no gain. It's bought and sold for the same price, no gain.
Mm-hmm.
And the sellers took their position and they, based on their percentages, and they received a promissory note for the net proceeds, right? But guess what? They have an extra about 40% more than they would have had, given the tax situation. The buyer takes title, they're gone. They got everything they bargained for. And what's left is the money sitting at Charles Schwab to start. Okay. And then
Mhm.
immediately we were going into, T-bills, money market at 5%, and then lending was basically the first 18 months. And then along the way, guess what happened to the real estate market? It went like
Went
this,
out. Yeah.
maybe a little bit more, and then it went like this. Woo, and we're on this downward trend. And now they've been dollar cost averaging into these multifamily, hotel. They actually bought Bitcoin. One of the clients did for 250,000 with part of it, and at
Mhm.
40,000 a coin, and it went to what? It's like 70,000 a coin today.
I've got a little bit of that, not a ton, but yeah, I know it's been on a run
Yeah,
lately.
and
I
so
see it every week when I do my personal updates.
So
Yeah.
think about that. What would be the alternative? They would have either not sold because they're like, I don't want to do a 1031, right? Which they don't get to capture, that big gain, and the values could be down where they're at now. Number two, they would have done a 1031 and they would have put it all back into another car wash at 13 million or something else. And that's not necessarily great either, because you have rate caps that are expiring and deals that you overpaid for. And so the deferred sales trust becomes that Netflix way of exit planning versus the old Blockbuster, right? You don't have to return it within 3 days. You don't have to, drive there. You don't have to rewind the video. You literally have a tax deferred vehicle that allows you to build wealth, to defer capital gains tax, and diversify your wealth. And so these are some of the things that we just teach people every day how to do. And we wrote a best-selling book on it, called Building a Capital Gains Tax Exit Plan. And we laid the whole thing out. And it's really the story of me being at Marcus and Millichap as a real estate multifamily broker, doing 1031 exchanges and finding that the 1031 exchange was not our friend when the market shifted, right? And it
Mhm.
was actually became the enemy, because in 04, 05, 06, everything was great. But then 07, 08, things shifted quickly. And I saw friends, family, and clients lose half or everything. And I was going through a similar situation, financially, not in the millions, but just barely hanging on. I'm nearly married, barely making any money at Marcus or Millichap. And I'm trying to figure out a way to put, the food on the table with the family, baby on the way. And so I did what I think any good real estate wannabe entrepreneur does. You get a side hustle. My side hustle is Cheesecake Factory. Night
Okay.
weekends, okay, selling avocado egg rolls. And by day, I'd work at Marcus and Millichap, negotiating with banks, talking with clients, and trying to help them hold on to their properties. And it's during this period of struggle that, after reflecting on this and looking back, is the moment we found this opportunity of this deferred sales trust, which at the time, most people thought, this sounds too good to be true. This will never work. Why don't we know about it? We thought we were the Navy SEALs of investment real estate. Come to find out, hey, if you're hungry enough and you're open enough, you can learn things that are going to change the trajectory of your career. And so that began the journey of me just sharing this, understanding it. And it took years, but after all these years of study and practice, my business grew. I was able to retire from the Cheesecake Factory. My wife's been
Yeah.
able to stay home full time with our kids the whole time. We have 5 kids now. We moved out of California to Florida. So we're in
Oh,
Northeast
okay.
now.
Yeah.
And that's kind of the story. Now we just teach people how to do this and execute these transactions every day.
I'm one of the rare people that did the opposite. I grew up in Florida and then I moved out of the state to Colorado, which has a state income tax. Not as bad as California, but
Not yet, but eventually I think they're getting closer and closer.
I call us like a mini California. Like we just in like every respect just kind of track behind by like a couple
Mhm.
years. But yeah, we'll catch up at
Yeah.
some point. And then so basically like from the investor side, then what you're doing is sounds like you're just paying tax every year on whatever you withdraw or whatever you're collecting in payments instead of the giant
Yeah, so let's
lump
talk about
sum.
the payments, right? And so the payments can be structured, principal and interest, or interest only, or partial interest payments. We just did an $8 million deal in Colorado, okay? And that interest rate on the promissory note was right around, I think, 8%, okay? And they deferred
Hmm.
about 35%. They deferred 100% of their capital gains tax, but an extra 35% working for them. So it's about 640,000 that's accruing in interest. Now they're delaying the payment for about 2 years. And guess what? They're establishing residency in Florida now. They kind of already had residency. They kind of already had half residency, but they're getting full-time residency. And so the income that you receive in the given year in the state you're in, that's the income tax you pay, right? And so that's a neat
Mm-hmm.
piece of this too. You can defer the income tax for a period of time. And again, so on the $8 million exit, they have an extra 2.8 million working for them in the trust. It's at a zero interest rate owed to the government, but as long as they just live off the interest of the eight, they're not paying any capital gains tax in the given year. And that's the plan. And that's what most of our clients structure. They're going to structure it with living off the interest. Now there are those that dip into principal, and if you do, you pay capital gains tax on that amount in the year that you take it, and the state that you take it, you pay back the state, or if it was Colorado or California or whatever, right? So these are all
Mm-hmm.
the ways that the DST is flexible for clients, and the payments can be adjusted typically, periodically. The note can be kind of refinanced. These are typically 10-year notes with a balloon payment due in 10. And let's say
Mm-hmm.
an average deal will be interest payments of 4 to 6% payout, and the other a couple percentage points is accruing. And then yeah, that's kind of the model. And then our entrepreneurial clients, you can partner with the trust. And when you partner with the trust, you can go do other deals. And so if you're listening to this and going, well, I'm a real estate entrepreneur, or I'm an investor who wants to be hands-on on my deals, or business owner. Well, guess what? The best kept secret is it can partner with you on that next deal. So it's kind of like a self-directed IRA. You can form an LLC, you can partner with the trust, and the trust, as long as it's investing in something it has commercial business use, right? It can
Mm-hmm.
do that. And so we had a client, he exited a business out of Tennessee or Alabama, and then he used the capital to help build 70 units in Tennessee, right?
Okay.
Ground development, all tax deferred, right? So that's a
Mm-hmm.
little of the case study here.
Well, the nice thing too, it sounds like you can put money into whatever you want once it's in the deferred trust, like you said, like even crypto and things like that. So in like the 1031, you're not as locked in to where you can put the money.
Yeah, exactly. So like we've done a crypto exit where they exited 5 million of Bitcoin at 54,000 a coin, deferred about 1.85 million of tax. And then they invested it some into the stock market, and they invested some into a startup company, like an online Khan Academy technology company. So as long as it's investment or business purpose, it can invest in anything. What can it invest in? Well, it can't invest tax deferred into a primary home, right? That's taxable,
Mm-hmm.
right? Or any payments you receive, you report and you pay tax on, right? And so if it's business or investments, it can go tax deferred. If it's personal payment or any personal like primary home use, that's taxable.
Okay. And are those rules similar to retirement accounts? Like I know retirement accounts have some weird exclusions, like you can't do what is it, like precious metals, collectibles, or like antique cars and stuff like that.
You got it. It's yeah, similar to those ways. Yep, you got it.
Cool. So out of curiosity, like you said, you started in real estate and held a bunch of different jobs. Like what did you study in college while you were playing basketball?
Yeah, so I first started at Point Loma down in San Diego, and I started out as a business major, and I was a walk-on and playing basketball. I was one of only 10 people to make the team, and I was the non-scholarship guy. There's me and one other guy. And so
Mm-hmm.
the next year, I did as a walk-on to a junior college down there, still studying business. And then I earned a scholarship to William Jessup University in the Rockland, Roseville, Sacramento, California area. And I have 2 degrees and a minor. So I studied business, Bible and theology, and then I have a minor in counseling psychology. I did that
Okay.
all in 5 years while also doing an internship at Marcus and Millichap and then college basketball. And so found out a way to be very efficient with the time that I had. And so I did it in 5 years because I blew my ACL out 2 weeks after I signed my scholarship. So I signed the scholarship. It's a big celebration. And 2 weeks later, I'm in the best shape of my life. And it was kind of just a freak accident, and boom, ACL's blown out. I have to take a year off. And that from there, I did a medical red shirt. And so I added an extra year, and that's what I ended up adding a minor. Why I was like, oh, I might as well do it while I'm at school, get a little more education. So that was my degrees.
Yeah, 2 degrees and a minor in 5 years is pretty good. I've known people that didn't get 1 degree in that amount of time. So that's not.
Yeah, it worked out. My brother and I were the first to graduate college from both sides of the family.
Oh,
Uh,
wow.
and so that's kind of unique as well. So it was always, my parents' dream for us to go to college and get a degree. So yeah, we did well there to fulfill that, and yeah, we're proud of the education that we've been able to achieve. So
No, very, very cool. And so then I know like you mentioned your book that you wrote, like I'm curious how the book writing process was for you. I wrote a book about 15 years ago and I'm considering doing another one. So I know sometimes those things can be kind of gigantic projects.
Yeah, great question. And so I hired a publisher, and we actually kind of did a little more unconventional method in that I did podcast interviews with people like Kevin Harrington from Shark Tank.
Mm-hmm.
And I don't know if you heard of Neil Bawa before, or David
Mm-hmm.
Young, or Don Winter, or Joe Fairless, Michael Blanc, Tyler McBroom, who's the CPA for Tony Robbins. And essentially, I invited all of them to come on my podcast. But number two, invited them to let the publisher edit the podcast interview and create a chapter, or create a chapter for each of their interviews. And so they say to get in a room with really smart people. Well, I got in a book with some really smart people, right? And
Mm-hmm.
so it's all. So when you see the book, it's building a capital gains tax exit plan. So I have a couple chapters in there, but so do the other authors. And so it wasn't as daunting because I'm a very, let's say, auditorial type, right? I can write too, but it helped to speed up the process. But then we went through and we edited it so you can read it. But that was the way that we sped it up, and it didn't feel so daunting, if that makes sense, Dan.
Yeah, no, that makes sense. The one that I wrote was on poker, and so it was kind of like writing a math textbook. So it was a little tougher process
Yeah, absolutely.
at the time. So I'm curious, like what kind of businesses are people selling that they're putting into the deferred uh sales trust?
Yeah, so we just helped a dentist out up in New Jersey. It was about a $2 million exit, and they had practiced for 20 plus years. This is their retirement. Their tax liability was around six to $700,000, and so for them it was just transformational. He goes, Brett, we can retire earlier. We can retire with more cash flow over the years, and we can live our lifestyle with more freedom and flexibility because of the deferred sales trust. And so, the car wash one we spoke about. The one in
Mm-hmm.
Colorado was like a family business. I don't want to disclose the name of the business, but it was a long time family business that's been in business for like 50 years, and they inherited it. My clients inherited it like 30 years ago, and they've been running it. It was a
Mm-hmm.
C corp. Yeah, there was another like a marketing business that was sold for another client. There was a $6 million healthcare business in South Florida sold for another client. Those are just to name a few, but yeah, this thing, you got car washes, you got car dealerships, you've got dentists, optometrists. It works for veterinarians. They did a veterinarian sale for a client out of Connecticut. Yeah, so really any business it works for. You just need to set it up prior to the close of escrow, right? It's key.
Mm-hmm.
$1 million net proceeds, $1 million gain needs to be large enough. And we work on a conditional basis. So you can come and sit down with us and we walk through it and see if it's a good fit. And you only owe us if you actually close. And so, yeah, but those are kind of the general businesses we've helped with.
Very cool. Yeah, I personally have been keeping my eyes peeled for more of what I would call I don't know, sort of standard like mom and pop, like local type businesses. So I have a bunch of friends that are doing that. One of my buddies just bought a landscaping business, one that had been existing for a long time and had somebody that's like a good operator. And, he shared some of the economics with that on me, and it just was, very super cool. So it just seems like a good way from maybe not the person that's exiting, but the person that's entering, a nice way to like invest money without necessarily sucking up a lot of your time as well, assuming you have it set up right.
Yeah, you nailed it. And it's a great way to unlock that deal in a favorable manner for that seller who's owned that business for a long time. So a lot of times people will approach a business seller at $10 million offer, and the seller wants 12. Well, why do they want 12? Probably to offset a lot of the tax. Now, if you approach them and say, well, what if we can solve that, defer that capital gains tax, and we'll still offer you the 10? They're like, wow, where's that been? I would have sold 2 years ago. In fact, they might even sell it for 9.5 now because they would have paid still 4 million of tax on the $12 million sale. Right.
Mm-hmm.
So this becomes the way to unlock deals, right? There's $84 trillion transferring in the next 20 years, 18 years by the baby boomers, mostly in America, mostly 77 million baby boomers in the US alone, 10,000 turning 65 every single day. This is known as the largest wealth transfer in the history of the planet. And they're going to get crushed with their taxes if they sell, or they're going to have a capital gains tax exit plan that's going to help them defer the taxes. By the way, people might ask, well, can you pass this on to your kids? Yeah, you can pass the promissory notes on to your kids. Your kids can step into your shoes and continue to tax deferral. You don't get the
Mhm.
stepped up basis. But by the way, they're considering taking that away. That's been proposed by Biden, as well as
Mhm.
the 1031 exchange being capped, right? So the deferred sales trust is perfect for right now in case that happens. We hope that stuff doesn't happen. But if it does, our business is going to boom even more because we'll be a great solution that's not tied to the 1031 and can still continue the tax deferral even past death.
Yeah, and that does seem like a great way to get a deal done, because I had somebody approach me a while back who was retiring and they wanted to sell their business, and that wasn't going to work out for various reasons. But we were, pretty far apart on price, and that seems like one of those nice things you can do to help close a gap, or, give them something they didn't know was there. And you as the buyer, you're not really giving anything up. You're
Absolutely. I mean,
yeah.
this honestly the number one thing sellers are thinking about, if not number two, maybe number two, but usually it's like capital gains tax. Like just bring it up. And I'm just telling you, like, if you go to my YouTube channel, in fact, you can watch my clients share their client success stories, with us, and we interview them on the podcast, and they're blown away, and their CPAs are skeptical and cautious, and oh, it's not going to work. And then the CPAs come on with this, and like, oh my gosh, this is incredible, right? And all their CPAs start sending us business. So this, yeah, this is, by the way, if we're running about the legal track record, close to 30-year track record, thousands of closes, and over 25 no change audits. So state and federal and formal audits. So it's batting 1,000 legally. There's lifetime audit defense built in. And so it works. It works very, very well. And it's never failed, never had a single change on any of the audits. And so I think the biggest thing for people, Dan, is understanding, how it works again, what the rules are, what the costs and the fees are, and really what kind of team is going to help me with this, right? And that's where we come in at Capital Gains Tax Solutions. We're the trustee. We help to coordinate A to Z, work with the tax attorneys to do the legal work, and then build a team of advisors, or just work with you as if you know how to invest, you know how and want to invest yourself, work with you to invest the funds. And that's the beauty of the DST. It's very flexible and can give people a lot of freedom.
Yeah, it sounds a little bit analogous. I mean, I know it's a different thing, but it sounds like there's some similar commonalities to like a self-directed IRA, whereas like people in the real estate investing world are, typically super familiar with them, but people who aren't, who have like employer sponsored 401k plans are like, oh, wait a minute, that doesn't sound right. And then they're surprised, or no, these things have been around since the 70s, right? And there's actually a lot of them out there. They're just not necessarily, there's not necessarily anybody out there that does mass marketing of them, because they don't fall into the same world of things that are sold by financial advisors and mutual fund companies and things like that.
You got it. Yeah, you're exactly right. You got to have someone educating, motivating, inspiring, and showing the deal stories to make it really come to life for people. And that's what we try to do with the DST as well.
Yeah, that's awesome. Yeah, because I haven't had the experience yet of selling a business for millions of dollars. I hope to do that at some point. But yeah, that sounds like a pretty cool way
Mhm.
to
Yep,
go about it. So,
absolutely.
well, cool. Well, Brett, thanks so much for joining and coming on and sharing all that with our audience. I know they'll definitely appreciate it.
Absolutely. And people want to find me, they can go to brettswarts.com, right? BRETTSWARTS.com. That has links to the YouTube channel, the podcast, the book, as well as capitalgainstaxsolutions.com, which is for all things building a capital gains tax exit plan using the deferred sales trust. And so just a little plug there in case people want to find me, Dan.
Yeah, and I'll put all those links in the notes as well so people can find them.
Cool.
Cool. Thank you. All right.
Thanks, Dan. Thanks, everybody.
Take care.